This past week, we saw both Halcone Resources and Kodiak Oil and Gas miss earnings estimates, and since then, the two companies' share prices have suffered. There are lots of reasons to sell stock, but Tyler, is an earnings miss really one of them?
Well, I think it's really hard to kind of justify buying or selling these two companies in particular based on an earnings beat to buy up or to sell on a miss. And I think what we can do is really look at some of the other metrics for this company to get a better color on that. Production for Halcone Resources and Kodiak Oil and Gas are up 237% and 127% year over year respectively. And both of these companies are getting better than $98 per barrel of oil in the Bakken, which is an amazing price realization. It's actually $10 better than some of the other top drillers in the space, like a Whiting Petroleum. They reported about $87 per barrel in the space right now. So if you look at it, earnings are up, cash flow is growing, and production is outpacing guidance way faster than I think a lot of people would have expected for these companies. And for oil and gas exploration, it's not an exact science. Kodiak Oil and Gas and Halcone Resources are actually kind of sacrificing some production right now to do some optimization tests with some of their rigs with things like different fracking techniques, different drilling techniques, to really trying to understand the Bakken better for the future.
Okay, so selling on an earnings miss may be an emotional decision. You shouldn't necessarily do it. But are there good reasons to potentially sell both of these companies, regardless?
I think both of these companies have very ambitious capital spending programs. Halcone Resources is expected to spend about $1.4 billion this year on development, and that's almost 79% of its entire market cap. So that's a pretty large investment. And also, Kodiak Oil and Gas isn't very far behind. They're looking to spend about $1 billion themselves. For smaller companies that were just a few years ago, a couple $100 million companies, that's a lot of money. And capex budgets for both of these are far outstripping their cash flows right now, and they're taking on sizable debt positions to make a lot of this production happen. So if these companies were to start having some sustained lull in production because some wells aren't performing like they would hope so, that high debt position could really bite into earnings and potentially bite into the company overall. So if you were invested in these two companies, would you really be worried about something like that? And there's not too much right now. CapEx is being used to put the drill into the ground rather than spending it on capital leaseholds, like a big problem we saw with Chesapeake Energy. One of their biggest problems was they were just spending money to keep an asset for no particular reason. Versus these companies, they're actually getting production from all this capital spend. So both of these companies should be able to grow into this debt position they've taken based on the production that they have right now. If it were to slow, though, then as an investor, I really might start to get worried.
Sure. I mean, debt situations have scared off any number of investors over time, and it's not an unreasonable, reason to get out of a stock. So, Tyler, thank you for breaking this down for us. Thank you for watching, and Fool On.